Good afternoon, advisors. Welcome to this month's webinar. We're rounding out our year of insurance by the numbers with just today and December left. This month's number is 9, and we focus on a topic that we know is of intense interest to advisors, the hybrids. Our presentation today will last between 50 and 60 minutes, and you must be logged in for at least 50 minutes from the email address you registered with to qualify for CFP-CE credits. If you have questions as we go along today, feel free to ask them on screen, and we'll do our best to answer them timely and anonymously. And as always, it's being recorded, and we'll post the webinar to our website within about a week. Your presenter today is Jerry Skapyak. Jerry's been in the insurance industry for more than 20 years and is our in-house annuity and hybrids solutions expert. He's the go-to guy for advisors with clients seeking to ensure they don't outlive their savings. And now here to tell us about the 9 clients who need a hybrid, here's Jerry.
Good afternoon, everybody. Thank you for tuning in this afternoon. We are going to spend some time talking about some hybrid solutions. But first, what I want to do is I want to talk about who is the one that really benefits from long-term care insurance. Most people probably think that it is the person receiving the care. Well, in reality, that person that's receiving that care is going to receive some form of care, whether they have insurance or not. Who really benefits from receiving the care is the spouse, family members, friends, the ones who would be taking care of that person if they don't have insurance. So let's take a look at some statistics. 65% of people who had to provide care for somebody missed work. May have been fewer hours, repeatedly late or absent, and some have even lost their jobs or have had to change careers because of caring for somebody at home. 46% say providing care impacts their personal health and well-being. Judith Maurer here always tells a story of her father was taking care of her mother. And he did really good for a few years of it, but as time went on, it wore on him. And when it finally got to the point of putting her mom into a nursing home, she almost thought she was going to have to put her father in also because of the toll it took on him personally taking care of his mother or of his wife. 53% had a loss of income due to the demands of providing care. I actually see this with my own parents. My father has to take care of my mom. Doesn't need full-time care by any means, but my dad was still able to work part-time, and recently, because her health has deteriorated a little bit, he hasn't even been able to work as much anymore. So he's experiencing that loss of income due to the hours he's not able to work. 21 hours is the average hour spent a week providing care. Now, I kind of have a little discrepancy with this number because I actually think it's higher. When you're providing care for somebody, you can't say, okay, I'm going to provide care for this person from 1 to 4 o'clock this afternoon. It's not like that. It's 5 minutes here, 10 minutes there, half hour here. And if that person is in the middle of doing something else, they have to stop what they're doing, start up taking care of that person, and then stop and then start doing what they were doing. So I think the actual hours of providing care is probably much larger than the 21 hours that's stated in this study. 37% said the spouse or partner relationship was impacted negatively because of providing care. If you think about that emotional stress and drain that's involved with that of providing care, and that may not be to the spouse, maybe taking care of a spouse's parents. These are my favorite slides in this whole PowerPoint. Let your daughter be a daughter, your spouse be a spouse, but not a caregiver. When we've had kids, we didn't have kids and go, yay, we now have somebody to take care of us in old age. That's not what people think when they have kids. They have their daughter to be a daughter. They get married to have a spouse. They didn't think all along that I was going to have this caregiver. Now, a lot of people think that in order of providing care, they have to do the physical aspect of it. And it's really a mind shift that if you have a policy that can pay for somebody to come and take and do that physical care, that's going to allow the daughter or you know, the spouse to be rested and be there mentally to provide mental care to the person receiving the physical care. So what we're going to do today is we're going to look at hybrid solutions. And what is so great with these hybrid solutions, it is a way to leverage sleeping dollars, whether that's money in a fixed account or money in an existing life insurance policy or an annuity that's sitting there is not really being used for what it was. We can take that money, move it to one of these hybrid policies, and have those policies do double duty. And then finally, these policies answer that #1 objection that people have to long-term care insurance. Why pay for something I may never use? So who are the ideal clients for these hybrid solutions? Well, one, they plan to self-insure. And if that client's going to plan to self-insure, also the ideal client for these hybrid products is someone who can write a big check. How big of a check? Well, the minimum for most of the policies is $50,000. To really get a policy with meaningful benefits, you really need to be looking more closer to $100,000. So these hybrid policies definitely work better when they are funded with a single premium. With the life policies, as you'll see, you can do some other premium payment options, but all the policies work best when funded with a single premium. They have an existing policy with a cash value. So if they have that life policy they bought when they were younger and, you know, it did a great job, provided that protection if something should happen to them, but as they get older, maybe they don't need that life insurance anymore. You know, by just repurposing that life insurance, taking that cash value, moving it to hybrid policy, we can have that money doing more work, doing double duty for the client. And the same goes for true with annuities. They want their money to do double duty. You know, that money sitting there idle in a life insurance policy or an annuity, we can move it over to hybrid policy and have it do that double duty. Number 5, they want guaranteed premiums. With the hybrid policies, everything is guaranteed in them. The insurance company cannot come back and after that client's paid that single premium and say, you know what, we've decided to raise our premiums, we need additional money now. They can't do that. Once it's purchased, it's guaranteed. They like the idea of long-term care, but they don't want to pay for something they may never use. It's going back to answering that #1 objection with purchasing long-term care insurance. You know, they don't want to pay $6,000, $7,000 a year for a long-term care policy that they may never use. So these hybrid policies can take care of handling that #1 objection. They want a guaranteed return of some benefit. Since these hybrid policies are like a combination of either life insurance and long-term care or an annuity and long-term care, someone's getting some benefit out of these policies. With the life insurance, they're either going to be used for long-term care or they're going to pay a death benefit. The annuity, same way. It's either going to be used for long-term care or it's going to pay a death benefit to the beneficiary. 8, all benefits out of these policies are paid tax-free, just like we see with traditional long-term care policies. And number 9 is don't qualify for traditional long-term care. And this is really pertaining to the annuity. The annuity has fairly simplified underwriting on it. So we've had quite a few clients that have been disqualified or denied coverage for traditional long-term care. We've been able to get them coverage with the hybrid annuity. I got a question here. Is the guarantee in writing? What if their sure goes broke? As with any life insurance, it is all based on the claims-paying ability of the insurance company. There is a state guarantee fund that backs every insurance company, or actually every policyholder in every state because it's done by state. But the guarantees are based on the claims-paying ability of the insurance company. Okay, so are hybrid benefits substandard? Actually, no, they're not. They're actually fairly similar to traditional long-term care benefits. So where can care be received? It's all the same places that you can receive care with a traditional policy. You can receive care in your home, which is the _1 place where almost everybody starts receiving care, and they want to receive care in their home as long as possible. It also can provide care at adult daycare, assisted living facility, and nursing homes. How do they qualify for this care? Just like a traditional policy, they have to not be able to do at least 2 of the activities of daily living. There are 6 of them. Also, as I've said before, any benefits paid out of these policies are paid on a tax-free basis. So today we're going to look at hybrid solutions. We're going to look at life insurance and annuities, and then we're going to talk about some long-term care comparisons with traditional and hybrid policies. Okay, I got a question here, more of an underwriting question. A client was recently diagnosed with MS. Can they qualify for the hybrid annuity? Unfortunately not. That is one of the conditions that is a knockout really for any kind of insurance, having MS. All right, so now we are going to focus on the hybrid life. And keep those questions coming. I love getting questions. So with the hybrid life policies, we can either maximize the death benefit, maximize the long-term care insurance component of it, or maximize the cash value. We just need a little direction from you, the advisor, to tell us what is most important to this client. There are several funding options with these policies. You can do a level pay into them. It is possible you don't get as many of the bells and whistles as you can with the policies where we can do like a 10 pay or shorter or a single pay, and we can also do a 1035 exchange from an existing cash value life insurance policy into the life policy. Before I get the question, no, you cannot go from an annuity to life insurance. You can go life insurance to life insurance, life insurance to an annuity. An annuity can only go annuity to annuity. There is underwriting required with the hybrid life policies. If we're looking at a single premium policy, the underwriting is much less than if we were doing a level pay policy, simply because with the single premium policies, the death benefit is very close to what that single premium is. Focus of those policies is really on the long-term care component, and we're going to go through some examples where you'll be able to see that. All long-term care benefits are paid tax-free to the owner, and the death benefit is paid tax-free to the beneficiary. With the hybrid options, we can really structure these just like a traditional long-term care policy. We have benefit options from 2 to 8 years, and we can also even get an unlimited benefit. We also have inflation that's available on them, either 3 or 5%, compound or simple. Okay, I got some more questions coming in here. States with partnership programs. These policies, the hybrid policies, do not help with the partnership programs. They are not partnership qualified. Okay, I got a clarification here. Just to clarify, tax-free is in the context of income tax-free, not estate tax-free. That is correct. Any of the long-term care benefits that are paid out of these policies are paid tax-free. The death benefit is going to be paid tax-free to the beneficiaries. All right. Moving on. Okay, so when we're talking about these hybrid life policies, I want everybody to think of them as buckets. So in bucket number 1, we have the long-term care benefits. So if the client needs long-term care coverage with this policy, those benefits that are paid for that are coming on a bucket number 1. In bucket number 2 are the death benefits. So if the client never needs long-term care or they don't use very much, that death benefit is going to be paid to that beneficiary, and that's going to come out of bucket number 2. And then even some policies have a third bucket, which is a return of premium. So if the client changes their mind and they don't want the policy anymore, some of the policies even have a full return of premium option with them. So what we're going to do is we're going to look at Albert. He's 55 years old, standard class. He's going to put $100,000 into a hybrid policy. Now, the $100,000 doesn't matter if he writes a check or if it's $100,000 that comes out of an existing life insurance policy. So Company A, this company has the largest death benefit that's available. And this company does their long-term care feature different than everybody else. What they do is that once a client qualifies for long-term care, they're going to write a single check to that client equal to 40% of the death benefit. So in this case, we're going to have a $464,000 death benefit. So once a client qualifies, they're going to have a check written to them for $185,000. And that client can spend that money any way they want. So the benefit to this policy is really that large death benefit. Company B, this is what I call a traditional hybrid policy. When I say traditional, I mean that the death benefit and their long-term care pool are both equal, and the monthly long-term care benefit that is paid is equal to 2% of the death benefit. But with this company, Company B, is they offer it as an indemnity. Now, typically with all long-term care insurance, for the most part, they are reimbursement policies. The client incurs the cost for care, and then they will submit the receipts to the insurance company and be reimbursed. With an indemnity policy, once that client receives one expense for a month, the insurance company is going to send them a check for the full monthly benefit. So with policy B, say the client has care for one day, it costs $150. The insurance company is going to send him a check for $6,230, and he can spend it, the client can spend it any way he wants. The benefit of this policy is really that monthly indemnity part. Company C, this is one specific company, but there are several companies that offer this return of premium here. It also has the largest long-term care pool and the highest monthly benefit. This policy is really designed to mimic traditional long-term care policies. The benefit of this policy is that return of premium and that large long-term care pool you can get with it. Company D, what is great with this company is it offers unlimited benefits. Now, if you have a client who has some assets, they can pay a little bit of that long-term care cost up front, but they are concerned about that catastrophic loss if they have a prolonged long-term care event. This product from Company D is a great product because with all long-term care insurance, you are using your own money first when you go on claim. So this $100,000, the client's using their own $100,000 first, and then, which is paid out through long-term care benefits, then they have riders on them that's going to carry that long-term care benefit for a period of time. So for the client that's concerned with that catastrophic loss, this Company D will provide those unlimited benefits to cover that cost. All right, I got some questions here. Those monthly benefits, i.e. 50, don't have to be used continuously. That is correct. They have to take a benefit 1 month, no benefit for 6 months, and take another. So yes, that is correct. You do not have to use the benefits continuously. Once the elimination periods have been met, as you need care, the policy will reimburse. I'll get back to it. All right. So we've talked just about Albert here, but what if Albert and his spouse Rose both want coverage? Well, there is one company that offers a second to die whole life policy, and it's actually the same company as D, but we're able to do it where we can combine both spouses, and it also has that unlimited or lifetime benefits available with it. So once again, if we have a couple who's concerned with that catastrophic loss scenario, Company E is a great company that can satisfy that need and provide that protection. But what I want to do now is I want to go back and focus on Company C. This is actually the policy offered from Lincoln Life, their MoneyGuard policy, but they're not the only ones. Genworth has a policy, Pac Life has a policy, and Liberty Mutual also has a policy that meets this criteria. But we're just going to talk about Lincoln mostly because they are the leader in hybrid life policies, so they provide the most out there. So we're going to go back and we're going to look at Albert here. He's going to qualify for a couples discount, and he's concerned that if he has a long-term care event, it's going to deplete his savings. So we're going to use his $100,000 premium, and we're going to look at a 6-year benefit period with a 3% compound inflation option. So here we're going to go back to our buckets. Albert's going to put in his $100,000, and right off the bat, year one, he's going to have a $5,920 monthly benefit, giving him an annual benefit of $71,000 and a total long-term care pool of $459,000. So if Albert kept his $100,000 in his life insurance policy, or if he had it in his savings account, his long-term care pool would have been that $100,000. By moving it to the hybrid life policy, he's taken that $100,000 and increased his long-term care pool by 459%. He's also going to have a death benefit of $142,000, and he has his return of premium of $100,000. Now let's fast forward to age 80. Because of that 3% compound inflation, his monthly benefit has grown to $12,396, and his long-term care pool has grown to $962,000. That's quite a big jump from that original $100,000 that he had. Our death benefit stays the same, and our return of premium stays the same. So what we want to do is I want to look at how does benefits paid out of the policy affect these different values. So we're going to assume Albert, at age 80, he goes on claim, and he's going to use the full benefit. So he's going to use the whole $148,000 a year for his long-term care benefits. When you go on claim, your long-term care benefits are subtracted dollar for dollar from your long-term care pool, your death benefit, and your return of premium option. So what we have at the end of age 80, his long-term care pool has been reduced to $813,000. We've taken more out of his policy than his return of premium, so he no longer has a return of premium or any cash value in the policy, so it's going to be zero. And since we've taken out more than the death benefit, his death benefit's reduced to zero. But since this is a life insurance policy, there has to be some death benefit on the policy in order for it to qualify as life insurance. So these policies have what's referred to as a residual death benefit. So in this case, Albert would still have a $7,100 death benefit, and actually that death benefit will stay there for the rest of his life and will be paid to his beneficiary. All right, so let's go to age 81. Our monthly benefit has grown. Now it's $12,768. Our long-term care pool continues to grow. It's grown to $837,000. Albert's going to go on claim again. Now he's going to take out the full $153,000 the next year. It gets subtracted from his long-term care pool dollar for dollar. His death benefit stays the same, and his return of premium is null because it was removed last time. So with the hybrid life options, there are some flexibility at time of design, and it varies by company. We also have elimination periods. You know, a lot of these policies have a 90-day elimination period. A lot of those single premium policies have a 0-day elimination period. So you could go on claim as soon as you go on claim, benefits will start being paid. We have options of premium payments, how we're going to pay for them. We got a choice of reimbursement or indemnity. We have inflation option protections, and we have long-term care insurance benefit periods. I got some other questions here. Does the long-term care benefit pool adjust for inflation over time, or is it locked in at normal values? I think we kind of addressed that already. It does go up with the inflation factor like a traditional long-term care policy would. Does owning an annuity inside of a trust affect the distribution of long-term care benefits or to the beneficiaries? You don't really want to put any of these policies, whether it's an annuity or a life insurance policy, inside a trust, because benefits are paid to the owner of the policy. So if the trust is the owner, those benefits are paid to the trust. So it doesn't really work because we want the benefits paid to the insured. Does money used to pay the hybrid have to be taxable money? In other words, is the money from the IRA ineligible? We're actually going to address that once we go over the annuities. Can you define the difference between indemnity versus reimbursement? With a reimbursement policy, you're going to incur the cost, submit those receipts to the insurance company, and be reimbursed. The indemnity type policies are once you receive some care in a given month, the insurance company is going to send you the full monthly benefit amount for that month. So you don't have to incur costs up to that monthly amount. All right, so now we're going to go through a case study that we have. Michael and Laurel. Michael's 54, Laurel's 53, and these are actual clients. So what did they have? Well, they both had small whole life policies with cash values and ongoing premiums. After their advisor worked with them a little bit, they didn't really need the life insurance as much anymore, but they had this gap in the plan. Actually, it was their final gap, and it was covering and taking care of long-term care. So, you know, they both had good net worth. That death benefit wasn't really the primary driver anymore. They both were engineers. They were great savers. They had cash values in these policies that really weren't doing anything for them anymore. The insurance exceeded its useful life to them. So what we looked at was reallocating those dollars out of that life insurance policy to cover their last planning risk they had. So Michael had almost $81,000 of cash value. What we did was a 1035 tax-free exchange into a hybrid life. His death benefit was equal to the cash value in this case. He ended up with a long-term care pool on day one of $282,000, and we were able to put 5% compound inflation on his policy. And when we went out to age 81, his long-term care benefits are going to be over $1 million. Plus, the policy has a guaranteed return of premium. So if at any point Michael decides, you know, he no longer wants his policy, he can surrender the policy and get his full $81,000 back. With Laurel, it's really kind of the same story, except she had $52,000, almost $53,000 in cash value. We did a 1035 exchange into a hybrid life. Her death benefit was actually a little bit higher than the premium paid at almost $69,000. Her long-term care pool was $187,000. We were able to put the 5% compound on her policy, and by age 80, her long-term care pool will have grown to $665,000, and she also had the return of premium on her policy. So what did we accomplish for them? Well, simply by reallocating existing dollars, having them do double duty, we were able to do this with that tax-free 1035 exchange. We were able to guarantee them a combined long-term care insurance pool of over $1.6 million by the time they reach age 80. And we guaranteed them no more premiums. And they still, since it's life insurance, it's a tax-free benefit to their beneficiaries, and the clients and advisors were able to check off the last planning concern they had. So what are the advantages to the hybrid life policies? Well, the long-term care benefits and death benefits that are paid out of the policies are tax-free. The premiums are guaranteed. They can't come back and require additional premiums or try to increase the premiums if they're paying level. They have full immediate benefits that are available to them. And they can fund, you know, either with a single premium, annual premiums, or a combo of both. The disadvantages are, well, some designs have limited liquidity, and the policies do require underwriting. I got a question here. What about a shared care policy for a couple with a hybrid? That actually goes back to the second to die whole life policy. Actually functions just like a second to die policy. Both spouses have access to the full monthly benefit, or they each have access to a full monthly benefit At the same time, it really works just like a policy with shared care. So now we're going to change gears a little bit, and we're going to talk about the hybrid annuity. Some of you may recognize these two people. That's Judith Maurer, the founder of LLIS, and Keith Maurer, her husband. Judith has often said that these hybrid policies are one of the greatest inventions the insurance industry has done since she's been working in it. They liked these policies so much that they actually put their money where their mouth is. And they both did it for different reasons with the hybrid annuity. Keith liked the idea that they were going to self-fund for long-term care, and they had a certain amount of assets set aside in a conservative investment. Keith liked it by putting it into a hybrid annuity. It's still a conservative investment that's going to earn a fixed interest rate. So to him, it's one and the same. If it's sitting over in this conservative investment account or if it's sitting in the annuity, didn't matter to him. Judith liked the idea of the hybrid annuity because taking part of that money, they were greatly increasing their long-term care pool and was going to provide her peace of mind that she was protecting her kids. All right, so with the hybrid annuity, long-term care benefits are paid tax-free. These are currently only available with a single premium on fixed annuities. So we're not able to do level payments in or 10 pays into the annuities, and we cannot do them on variable annuities. It has to be a fixed annuity. We can easily cover both spouses on one policy, so we're able to do shared care with the hybrid annuity by having them both on one policy. And it has to be non-qualified assets. We cannot use qualified assets into the hybrid annuity. So for all of you that send me those qualified annuities to review for you, the hybrid annuity is not an option for your clients. Now, your clients that have the non-qualified annuities, we can always talk about a hybrid option as an alternative for them. So the hybrid annuity, it is a great way to leverage assets for your clients to cover long-term care. How much leverage do you get? Typically, on average, it's about 2.5 times the premium put in. Long-term care benefits not used in the annuity, pass to the beneficiaries as a death benefit. Also, because it is annuity, they can always annuitize it if they want, or they can transfer the value to another annuity. It's an annuity at heart that just has a long-term care rider on it. Long-term care benefits may grow at a higher rate than the annuity's cash value, and we're going to cover that in a minute. And if the clients have an existing annuity or life policy that they no longer need, we could transfer both the life or the annuity cash values into the hybrid annuity and start having that money do double duty. So why is the annuity so attractive? Well, you got clients, you've reached a comfortable retirement age. We're going to use Albert and Rose here. They're both 66. They have that risk. You know, they want to self-insure, but those assets that they have set aside are only going to go so far. So there's rewards with using the annuity. All the benefits, they're getting all the benefits of self-insuring, but with a bonus. So let's look at if Albert and Rose were to self-insure. They got $100,000 earmarked into a fixed account for a rainy day. If they don't need long-term care, that $100,000 is going to pass to their kids. And if they need access to that money in life, they have access to that $100,000. If they need long-term care insurance, though, their pool is $100,000. And once they've depleted that pool for long-term care, they have to go get assets from elsewhere. Okay, I got a question here. If you annuitize the annuity for a payout, but then need long-term care, do you get long-term care benefits still? No, you do not. You have the option to annuitize it, but at that point, you're getting rid of any long-term care benefits you would have with the policy. if one was in good shape, but be better to buy one policy for each, life and long-term care versus a hybrid. Those are numbers that we would really need to crunch. With traditional long-term care, you get a substantial discount if both spouses are able to apply, so you wouldn't be able to get that discount if one of them we knew upfront was uninsurable. All right. All right, so, but if Albert and Rose just simply takes that $100,000 and move it to hybrid annuity, they're going to have a lot of the same options they have if they were going to self-fund, but some additional. For one, we're going to have that money do double duty. So if they don't need long-term care, at death, the value of the annuity is going to pass to the kids. In life, if they need access to it, well, it is a fixed annuity, and all fixed annuities have a surrender charge. So with this annuity, it does have a 9-year surrender charge, so their access to the cash value is limited, but they do have access to 10% of it without any penalties. But if they need long-term care, now this is where it gets really interesting with this policy. So you have 3 options with the hybrid annuity. If you remember before, I said with these hybrid policies, you're going to use your own money first. So our clients are going to use their $100,000 first. Then there's a rider that goes on the annuity. So option 1 is 36 months, option 2 is 72, and option 3, 108 months. So here we have Albert and Rose. We're going to go to, they bought a hybrid annuity, and we're going to go to the end of year 1. And let's compare self-funding to the various options that are available with the annuity. So we're going to be nice with the self-fund, and we're going to grow it at 1%. So I don't know, we're being conservative or actually being nice with that in a guaranteed fixed account that's safe and secure, giving them 1%. So at the end of year 1, they have $101,000. Now with these hybrid annuities, we got a couple of things going on here. What I want to focus on first is this long-term care accumulation value. All of this is that's the client's premium growing at a slightly higher interest rate than their account value. And this long-term care accumulation value is used in calculating part of their long-term care pool. The other part of their pool is that rider that they have, the 36, 72, or 108 months. So if we look at option 2, our long-term care accumulation values almost $101,000. We have our long-term care extension, and this adds up to $343,381. Now you'll notice, though, on these, our cash value goes down with the longer of the benefit period riders we select. The reason for that is there is a cost for the long-term care portion of the policy. So the larger that long-term care pool is, the greater that cost is, so it's subtracted from the account value. Now we're going to fast forward to age 85. Our self-funding account, we're going to say, is growing to $122,000. We're going to look at option 2 here. Our account value has gone down a little bit more, but our long-term care pool has also grown. Now anybody who's really buying one of these policies, their primary purpose for buying one of these hybrid policies is for the long-term care component of it. So as long as we got that long-term care benefit growing, we should all be happy. So at age 85, we're going to say our clients need to start receiving care. And because it is a joint policy, it works just like shared care. They both can go on claim at the same time, or be on claim at the same time, and they each can receive up to the full monthly benefit. In our example, just to keep numbers simple, we're going to use, say, they each take $3,300 a month, making it a total of $79,200 a year. So when they go on claim, that amount is subtracted dollar from all of our accounts. So our self-funding account would be dropped down to $42,800. Our account value is subtracted dollar for dollar, and it's subtracted dollar for dollar from our long-term care accumulation value, and therefore subtracted dollar for dollar from the long-term care pool. So this will go on each year. So if we went on and showed year 2, our self-funding account would have a negative number. So meaning that already the clients are going to have to start looking elsewhere to continue to pay that care, whereas the hybrid policy is going to continue to provide care to the client. All right, so what are the advantages of the hybrid annuity? We get immediate full coverage with over 2 times the premium paid in. Benefits paid out are tax-free. Remaining account values passed on at death. We do have shared care available with it. We have simplified underwriting, which is a huge benefit with that policy. We have some possible growth of benefits. We have access to the cash value if needed, and it's a guaranteed solution. The disadvantage to it, right now interest rates are low, so it's reflected in the values of the annuity right now because the rates are low. So one more niche with these hybrid policies. We're often asked for, with traditional long-term care, is there a way that we can get a long elimination period on those policies? Well, the states dictate how long an elimination period can be on a policy, and no state offers an elimination period greater than 1 year. But with these hybrid life policies, since the client's putting in their money and they use their own money first, it's like they have that long elimination period they're looking for. With the annuity, it happens to be 24 months. With the life insurance, it may be 50 months that they're paying themselves out of their pocket. So once again, these are a great way, for those clients who have some assets, they want that long elimination period but can't get it on a traditional long-term care policy. We can get it with the hybrid policies. All right, so let's look at some comparisons. We're going to look at Albert again, who's 55, and he's looking for $5,000 a month in long-term care benefits, a 90-day elimination period, 5-year benefit period, and we're going to look at no inflation, simply because not every long-term care option out there offers inflation. So this is the closest way we can come to try to comparing all these different long-term care options on an apples-to-apples basis. So with a traditional policy, to get that $5,000 monthly benefit, the annual premium would be $1,684. That may be a lot lower than what a lot of you have seen, and that's because it doesn't have inflation on it. So our cost out to age 85 is basically $50,500. We have no death benefit and no cash values at age 85. Our annuity is going to take a single premium of $117,000. Cost to age 85 is just our single premium. Our death benefit is going to be $169,000. Why is that? That's because the cash values grow a little bit on the policy over time. Our life policy is going to take a single premium of just about $97,000. That's our cost to age 85. Gives us a $180,000 death benefit, and our cash value at 85 is going to be equal to that premium that was paid. And then our final one is more of a traditional hybrid life policy where you can make an annual premium payment on it. On that policy, it's going to be $4,400 a year. Our cost to age 85 is $132,000, and our death benefit is $250,000. At age 85, there's no cash value in this policy, though. So which one's right for your client? Well, it kind of depends. What we call is an internal rate of return advantage. So if you know your client is going to go on claim and need long-term care, well then by far traditional long-term care policy is the best policy to have because it's the least expensive if you know the client's going to go on claim. If your client's worried about that, they may want to surrender the policy at some point, the annuity is your best option. It's going to provide you with the most cash value in the future. If you're looking for a combination of death benefit and surrender value, then our single premium hybrid life policy is the best one to handle that. And then finally, if we're concerned with the death benefit, we got our level pay hybrid life policy to provide that death benefit. So if you kind of just, give us an idea, give us some guidance as to what the clients, what's most important to them, we can kind of structure that policy to meet their needs. So let's look at an actual case study. I love this case study. We have done similar examples like this for several clients. Excuse me. So here we have Steve and Karen, who are both age 60, who want long-term care. They were looking for $6,000 a monthly benefit, a 4-year benefit period, 3% compound inflation, and a 90-day elimination period. Their premium for that policy was $5,088. Now, in talking with Steve and his advisor, it was mentioned to me that Steve had a permanent life insurance policy. It had a death benefit of almost $99,000 and had a cash value of $78,700. Steve didn't need the life insurance anymore. He just had it because it was almost a paid-up policy. Dividends were paying it, but didn't need it. So what we looked at was doing a 1035 exchange into a hybrid life policy. So what we got him was a monthly benefit of $4,112. We got him the 4-year benefit and the 3% compound inflation to match what they were looking for on the traditional long-term care policy. And his death benefit on the policy was actually more than what he originally had on his whole life policy. He ended up with a death benefit of $106,000. And he has return of premium, so if he decides at some point he doesn't want this policy anymore, he can get his $78,000 back. So now when we go back and looking at what our ultimate goal was for them, we wanted to get them $6,000 a month of long-term care benefits. So Steve was going to get $4,100 from his hybrid life policy. So with the traditional long-term care policy, we looked at just $1,900 for him of benefits, giving him a total of the $6,000 he needed. Karen, we went with the $6,000 benefits for her, so they each got their $6,000 worth of benefits. And combined, the original premium was a little over $5,000. Well, their combined premium now was only $2,900. We were able to save them almost $2,200 a year, just by the advisor telling me a little bit about what the client has and us working together to find the best solution for the client. So, did you know that we are going to be doing a webinar coming up next week for the Garrett Planning Network, and we're also going to be doing a virtual workshop for them next month. And if you don't know about this yet, we are going to be doing our Insurance Academy again next year in February. Registration is open. If you're looking for more information on insurance and want to get down to sunny Florida in February and get out of probably the cold area where you're living, sign up for this. It's not very expensive, and come on down and visit with us. You probably noticed we got a new logo. We are also working on our website and hope to have that out soon. I will get to your questions once I get done here. Top 10 things that make LLIS different. Well, one is our webinars that we do. We got our final one of the year coming up. It's going to be on 1035 exchanges. As many of you know, we're not your competition. The only thing we do is life insurance. We save you, the advisor, time and your clients money by doing a lot of pre-underwriting up front and having your clients apply with the appropriate companies. We're a proud sponsor of all these different organizations. We have product specialists for the various lines. I am the annuities and hybrid specialist for the company. We also have a life specialist, a disability and long-term care specialist. For those of you who have had clients purchase insurance through us in the past, you've probably seen these AIM emails that come to you. These are great. Once your clients go into the underwriting process, you and the clients can receive this email, and it's going to give you a step-by-step process of what's going to happen in the underwriting process, and it tells you approximately how long each one of those steps is going to take. So once your client goes in the underwriting process, there should be very little reason for you to have to call us to see where your client's at in the process, because you're going to be kept up to date with these emails. And finally, Once your client purchases a policy, the service doesn't stop there. We handle all in-force service for your clients. We're going to send you an email about a month before premiums are due. You and the client, it's amazing how many clients move and don't tell insurance companies. This has greatly cut down on the number of policies that have lapsed. And then finally, we're going to let you know when their term policies are about ready to expire. We're going to send you an email about 3 or 4 months ahead of time to see, do we still need coverage? If so, we need to start that underwriting process now. So let me get to some of these questions that have come up. Okay, is there generally a maximum age limit acceptable for converting an existing annuity or life policy to a hybrid? The policies do have some maximum ages. Generally, they are right around the age of 75. It will vary a little bit by company. The main reason the policies have come about is because of the increased costs traditional long-term care policies have seen. No, that's not a reason. Actually, it was the Pension Protection Act of 2006 that made the hybrid policies really possible. If you inherit an annuity as a beneficiary, can this be exchanged to a long-term care hybrid? No, it cannot, because those inherited annuities have to have, in a sense, RMDs taken out of them. You can't defer them forever. How much flexibility is there to add additional premiums to the hybrid products? I've kind of talked a lot about using these as single premiums. It depends on how the policy is set up originally. A lot of the single premium policies will allow up to a 10 pay on them. You can do shorter if you want. If you want to do anything more than that, we have to go really more to a level pay type policy, and we can structure that at any point. But once a policy is issued, we kind of have to state up front how the premiums are going to be coming in, though. How do these? Can you review the previous slide comparing the benefits for Steve? Sure, let me go back to that. It doesn't want to work. Oh, at least we're in the PowerPoint. It's 47. Oh, sorry. Sorry, everybody. There we go. So somebody was asking about, go over the benefits for Steve. So with Steve, we were able to use his cash value in his life insurance policy to buy a hybrid policy. And if you remember, he was looking for $6,000 a month of long-term care benefits. So since this hybrid policy is going to provide, $4,100 of it, he didn't need as much coverage out of the traditional long-term care policy because it was covered with this hybrid policy. So when we go down here, we only had to add the $1,900 from a traditional policy, or put $1,900 on the traditional policy to give him a total of $6,000 between his hybrid and the traditional policy. Given that no one really knows whether they'll need long-term care, what is the downside to the hybrid policies? Well, for example, we kind of talked about advantages and disadvantages of each one. With the hybrid life policies, your disadvantages are, there are some underwriting that the client's going to have to go through with it, and you're not going to have as large a death benefit as if you were going to buy just a single premium life insurance policy, because there are some costs internal in those policies to cover the long-term care also. And then with the annuity, the downside really is the low interest rates environment right now on that policy. Covered that one. How do you feel about actuarial projections on these policies versus long-term care only policies that are now becoming so problematic? Generally, earnings release. I really don't have a comment on that. I'm not sure with the actuarial projections on these policies. They are priced, like the single premium policies are really priced like long-term care policies. They're just done inside of a life insurance policy that's going to, cover how all that's going to work. A single premium life policy as a MEC will distributions for long-term care qualify for tax-free treatment. Yes, actually all of the single premium life policies are MEC policies, but the distributions coming out of them are tax-free. Are tax deductions for life insurance premiums attributed to long-term care? I don't believe they are. I've never read anywhere where they are. Okay, what about giving away $100,000 and then taking Medicaid? I am not a tax planner. My understanding is there's going to be a look back on that. So if your client's concerned about qualifying for Medicaid, they should really talk to a Medicaid attorney for that. Looking at a couple others there. How do these work for older clients, or do they, e.g., a healthy woman in her 80s and has a policy with cash value of $75K? Well, you have a maximum issue age first off on the policies, and it's right around age 70 for them. The older you are, the less of a monthly long-term care benefit you're going to get. I know, for example, like with the annuity, the older the clients, you can't get as long of a benefit period on them either. So the age will impact the benefits some. All right. What age is too young to purchase long-term care insurance? What we've typically said when it comes to purchasing long-term care insurance, you don't want to really consider looking at it until the client has accumulated enough assets that they want to protect if they have a long-term care event. Because while they're accumulating assets, it's more important that they have disability insurance to protect that income, and that they have life insurance to take care of the family if something happens to them and they're not able to work and provide that. Is there generally an age which is the sweet spot for doing this? I.e., as you're saying now, there may be too old, but is there too young? Typically with the hybrid policy, since we're looking at single premium policies, it's generally older clients, older in that they're typically 55 on up is where we really see these being used. Haven't really looked at anybody young trying to purchase them because it's usually, once again, the issue of the single premium. Can a surviving spouse continue just the annuity contract as a beneficiary of a hybrid annuity product? If she was not on the policy as an annuity or as an annuitant to start with, no, she would not be able to continue the policy. All right, I see that it's 5 o'clock. Thank you, everybody, for tuning in. And if there's a couple questions I haven't got to, we will get back to you via email. Thank you, everybody. Have a good evening.